how are mortgage interest rates determined? We're going to talk all about all the different factors, and we're getting started right now. Hey, what's going on? Emmett Dempsey, mortgage broker and owner of Treasure Coast Mortgage here in Port Saint Lucie, Florida, and welcome to another video. On this channel, we talk more about mortgages, the home buying process, and some cool things about moving to Florida, Port Saint Lucie, and what have you. So if you're new here, please think about subscribing. Also, please go ahead and leave a like and a comment on this video. It really helps the algorithm find my videos to help more folks just like you. And with that out of the way, let's go ahead and talk about mortgage rates. Okay, how are mortgage interest rates determined? Now, so often, there's a lot of misinformation out there. You see a lot of things quoted, a lot of fine print. Well, what's your rate? Like, that's a question I get. Say, hey, what's your rate? Shop around, what's your rate? So the answer to that question, like I always say, the answer is it depends. There is a few different factors that go into what your interest rate would be. And everyone's interest rate is different. And it's based off a set of principles, and first of all, we start with market-based forces, okay? So the core of any mortgage rate has to do with what's going on in the economy. And how is that reflection in the economy? It's in the bond market. So there's things called mortgage-backed securities. So if you imagine all of your neighbors' mortgages that are all, all your neighbors, all their mortgages are packaged into one piece of paper, kind of called a mortgage-backed security, and that's traded on the bond market. And like your pension funds and big insurance companies who need to fund their obligations, they buy these bonds because they pay a rate of return. So based on the rate of return that they pay is based off of things like inflation, the economic news. So usually if unemployment, all those economic factors go into how the pricing of those mortgage bonds are determined, and ultimately the core of those mortgage-backed pricing, that's going to determine the core economic interest rate. So I know last year in 2020, in lieu of COVID, we had some business closures and shutdowns, and so once stimulus needs to go into the economy, usually the inflation is tampered down because there's not a lot of economic activity, so rates will drop. And then usually when the economy is roaring, it happens the other way, where the inflation's going up because you have to hire more people to keep up. And so interest rates pressure is upwards. So that's just the core of interest rates will be the economy. So right now we're in a very good interest rate market. I've been doing mortgages since 2007 when 7% was all the rage. Now rates are in the twos, and I can even touch the ones, the high ones. So it's definitely a great area to be in. So number one is the economic factors. Okay. Number two, so that forms the base rate. So the next how is determine your risk, your loan's risk. And all starts, as you may understand, is your FICO score. Okay. So we use the FICO score, not the Vantage or like that. Usually it's FICO version 4, and we take the middle FICO score of the 3 major bureaus. So FICO score is going to determine one thing. Also, the type of mortgage it is, because there's VA, there's FHA, USDA, different loan types of different loan features. For instance, FHA and VA are government insured, so the risk of those loans of default is lower. So therefore, they can lower that interest rate. Whereas conventional loans, without mortgage insurance, there's no assurance of the lender to make those loans, so that they price that risk higher. So generally, the starting interest rate for everyone is just higher on a conventional loan versus FHA and VA. I have some other FHA videos. I go in FHA versus conventional, all of those different details. So go ahead and check this video out. So it all depends on, number one, your FICO, the loan type, with a conventional, and usually the FICO will tell me which way to go, based on also your personal situation. Say you had a short sale foreclosure within the 3 years or more, so you would have to go FHA. So I'll tell them. That's why I say your interest rate will differ from your neighbor's interest rate because of your personal situation. So, which way do we go? So that's how we determine, the interest rate on FHA. Starts with your FICO, and it gets priced based on risk. Also, the certain property. If you're buying a condo, that's going to be more risky because you're sharing walls. It's deeded differently. It's hard to sell. Single family homes generally have lower rates because they're easier sold. And it's just this lower risk. So FICO's a consideration, loan type, and also how much you're putting down. Well, on a purchase, if you put down more, usually if you put down 40%, your risk is lower because you're building a lot of equity in. Or if you're putting down the minimum, of course that rate is going to be risk higher. But also they mitigate that risk with what's called mortgage insurance. And it's interesting, sometimes if you can get a little bit of mortgage insurance, like if you put down 15% versus 20, that loan, the conventional loan is insured, maybe a little bit lower rate because lower risk. So aftermarket forces are risk-based forces. Like I said, it comes down to your FICO, comes down to how much you're putting down on a refinance, your loan to value, if it's a single-family home, the property type, but also if it's owner-occupied. So if you're buying investment property, you're having to put down more money. The rate is higher because of the rate of default. So, after the core market rate, they determine your risk rate. And that's how we come up with your interest rate. And what I always do also is have choices. What I always present is options. Like here's with no points, and here's buying down points, and it may or may not make sense. But ultimately, the answer to the question is what's your rate is always, it depends on what your goals are. So my job for you is to lay out all of your options, what's possible, and then you execute on the solution that works best for you and your family. So that's how mortgage interest rates are determined. These videos right here are going to talk about some more cool mortgage topics. Thank you so much for watching, and I'll see you guys on the next one.